The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special report section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning.
Good morning.
Good morning, everybody.
So my goodness, we are already at the end of May. How time flies. Anyway, thank you for taking the time to be with us today. Please remember that you can always send Randy an email if you have a topic or question you'd like us to address on the air. If you have a question, we are sure that other listeners probably have the same question. So Randy at rfmoney.com.
I just had a very random thought while you were saying, wow, it's already May.
Yeah.
I remember vividly where I was when we were approaching Y2K.
Me too.
And all of a sudden, that was 26 and a half years ago. So
That's crazy.
Man, you weren't even born yet, I don't think.
Yeah, he was. He was.
Yeah.
26 and a half years ago? What year were you born?
Wait, I was 26 and 2 months ago I was born.
So there
Real
you go.
close.
He was still drooling.
We were all
himself.
scared the world was going to end when 1999 went into 2000 because the computers weren't going to be able to handle it.
Right.
And then like it happened, midnight struck, and we were like, hey,
Nothing changed.
we're here. We're alive. The computers didn't kill us all. So anyway,
Oh,
yeah,
gosh.
it is already May of 2026. So inflation continues to hit consumer wallets. The April PCE, which is the personal consumption expenditures, the data from that shows a 0.2% increase in April and a 3.3% increase year over year. These numbers were for the core PCE, which excludes food and energy. These numbers were in line with forecasts, but the hope is that these soft monthly readings could provide some hope that the previous increase in prices has begun to ease.
The U.S. GDP accelerated at an annualized rate of just 1.6% in the first quarter, according to a revised Commerce Department reading that was below the initial estimate of 2%. The Commerce Department said that the initial reading was cut because of downward revisions to consumer spending and investment.
Because of these numbers, traders expect the Fed to hold rates as they are now, at least until late in 2026, if even then. Currently, markets are pricing in the likelihood that the central bank's next move will be a rate increase, possibly in the early part of the next year. New Fed Chair Kevin Warsh has indicated he believes the central bank's benchmark rate could be lowered, though he's likely to face opposition from the rest of the Federal Open Market Committee members.
Yeah, he's on a balancing beam right now.
Yes.
So, okay. I want to jump back to your opening, Sherry, about people sending in questions to be addressed on the show. I recently received an email asking us to discuss dividends versus yields. That's a good question, so we're going to delve into that right now. And dividends are paid in dollars, and yields are simply an annualized dividend divided by the share price, expressed as a percentage. Now, if you receive quarterly dividends, then you would add the last 4 payouts and divide the total by the current stock price. If you receive dividends, say monthly, quarterly, semi-annually, or annually, the current yield is typically based on the rolling 4 quarters. So they call that the 12-month, the trailing 12-month dividend. The acronym for that you might see in Financial Times is TTM. An example would be you own a stock with a price of $50 and you've received a total of $2.10 in dividends over the trailing 12 months. Then your current yield would be 4.2%. That's $2.10 divided by 50. So if the dividend is semi-annual, you just add the 2 dividends and divide the stock by the price. Annual dividend payments use just a single payment. Most financial sites use TTM, so what you see is a backwards-looking perspective. And if the dividend was recently cut or increased, the current yield may not reflect the new run rate yet. And I will tell you that I've seen data on Yahoo and then compared that to what's on MarketBeat, and they have two different numbers. They're close, but they're not identical as you might expect. So don't think there's something wrong. It's just the way it is.
While the TTM uses a backwards-looking viewpoint, there's also a forward yield. In this case, analysts use the last dividend, multiply it by 4 if the company pays quarterly, or quarterly divides by 2 if they pay semi-annually. As an investor, it is a good thing when your yield goes down while your dividend is going up. For example, Johnson & Johnson, from 2015 to 2025, dividend income grew by 74%, going from $2.95 per share in 2015 to $5.14 per share in 2025. At the same time, the share price grew by 101%, going from $102.72 to $206.95. So while the dividend fell by 39 cents in the last 10-year period, the stock more than doubled in the same period. That is a good trade-off.
That is a good trade-off. Sometimes investors make the mistake of chasing yields, though. And we've seen this. Quality, well-run, and well-capitalized companies tend to grow their earnings over time. Mature, established companies that grow their earnings tend to also grow their dividends as well. Generally speaking, earnings growth drives share price growth over time. The balance between share price and growth and dividend growth tends to keep the yield from getting too high, which is a healthy attribute.
That's right. And remember, chasing high yields may have high yields for a reason, for risky reasons. So be careful about chasing high yields. But know that not all companies will perform as Johnson & Johnson has. This is a company was chosen just for illustrative purposes, and it's not in our portfolio nor an endorsement of the company. Another question to ask yourself is, do you need the income now? There's a double compounding effect when you have the dividends reinvested in the company stock that is paying the dividend. When you have the dividend automatically reinvested, that simply buys more shares of the same holding, and those additional shares pay more dividends on the next cycle of the schedule, of the dividend schedule. And remember that dividends are paid on the number of shares owned, not what the shares are worth. So the more shares that you own, the more cash you're going to generate in dividends.
And the question Randy just asked is important. That is, do you need the dividend income now? When dividends are reinvested, you are increasing your income power by increasing the shares you own. If you're younger and don't need the income right now, then you can continue to accrue more stock and then down the road, start taking the dividends in cash versus buying more stock. This is a great way to increase your monthly income down the road, and I have a lot of clients who do this. If you are taking an RMD, the IRS wants you to drain that account in your lifetime. Why? Because they want the taxes that were deferred while you were in the accumulation phase of life. RMDs are calculated using the projected life expectancy of a person based on actuary tables set by the IRS. And as you age, the percentage you are required to withdraw increases. Your goal is to preserve your IRA balance for yourself and possibly beneficiaries.
Yep. So leveraging a rising dividend to offset a rising RMD and diminishing accounts paying for those RMDs. It's a good way to somewhat insulate yourself and protect your cash flow as your IRA is being reduced by the RMD itself. And as you get older, you want to ensure that you have a good cash flow to maintain a quality of living.
Agreed. We look at these projections for our clients all the time as they want to make sure they are doing the right thing for the long term.
Yep.
All right, next up, 1 million new car buyers are gone, and they're not coming back anytime soon. High gas prices, rising interest rates, and stubborn inflation are keeping buyers at home and cars on the lots. The U.S. auto industry faces sobering new math. Some 1 million prospective buyers have defected from the new car market since the start of the decade, and they aren't expected to come back. Not anytime soon, at least. Until recently, auto executives, analysts, and economists believed that U.S. new car sales were on a steady climb back to volumes last seen before the pandemic forced automotive factories to close and scrambled global supply chains. That is no longer the case. General Motors, Ford Motor, Toyota, and other automakers have said that they are planning for sales of new cars to shrink or stagnate this year after consumers, stung by persistent inflation, rising fuel prices, and high interest rates, are balking at prices that have risen to around $50,000 on average.
Americans were buying around 17 million cars and trucks a year before 2020, but now industry analysts don't expect the market to return to that level until the end of the decade or later. They now forecast total annual sales of about 16 million vehicles or fewer this year, and that outlook has grown even dimmer as the conflict in Iran keeps gas prices high. This is a real threat to the whole industry, and this is not just the U.S. markets. The European automotive markets are experiencing the same thing. Volvo executives said that this is proof of something more fundamental, which is wrong in the general economy, that people are not able to buy new cars.
Yep. In the U.S., about 1/4 of models priced between $25,000 and $35,000, and even a bigger share tops $55,000. Executives at the world's biggest automakers say they recognize that a new car is out of reach for more Americans. Some have promised to bring about more affordable models, but no one predicts a significant relief anytime soon. So if you're old enough to remember when auto dealers wanted to get rid of cars at the end of the year or sales were stagnant, they would offer increased incentives like 0% financing and great rebates, or just mark the cars down. That isn't the case this time, particularly as American automaker giants Ford, GM, and Stellantis are making profit selling fewer vehicles. And since automakers are making good profit margins selling big trucks and SUVs, they are in no rush to offer cheaper cars.
That means buyers are left with few options. They could turn to used cars, but those are similarly climbing in price. Many choose to keep their old cars running longer, which can be seen in data which show the average car on U.S. roads is now about 13 years old, which is a historic high. Profits from more expensive vehicles are helping offset the higher cost of doing business in the auto industry. Nearly every automaker is paying billions of dollars more each year to foot the bill for President Trump's tariffs. Ford incurred about $2 billion in tariffs last year. Car companies are also erasing billions from their balance sheets as they walk back costly electric vehicle investments.
True, but automakers face a balancing act. They stress the need for more affordable options, yet right now, their business is fine without them. Basically, there is no incentive for them to act on their own intentions. GM, for example, is spending billions to upgrade factories that make lucrative pickups, SUVs, and V8 engines. At the same time, the automaker just pumped $600 million into a South Korean unit that builds its lowest cost U.S. models that are in hot demand and short supply. GM has said that even with tariffs, those models, which are 4 compact SUVs that sell for less than $30,000, do make money. Yet introducing new cheap models isn't part of GM's plan. A spokesman said that the company is very comfortable with its portfolio the way it stands today, noting that developing a new vehicle is costly and money the company should spend only if a model will add value over time.
At Ford, many dealers were irate after they scrubbed its line of all sedans and cheaper SUVs over the past few years. Last to go was the compact Escape SUV. Ford CEO Jim Farley said the company may get back into sedans, which Detroit automakers ceded almost entirely to foreign rivals over the past decade. But the company has grappled with how to make those lower-cost models cheap enough so that they don't lose money. Farley has promised a string of more affordable models, including an electric pickup truck starting at around $30,000. For now, the company is touting the success of some of its priciest models like the Expedition and Bronco SUVs.
And, Farley has to do that as a business. He has to look at what's profitable and,
Sure.
Right.
Because if he didn't, the shareholders would can him. So,
Right.
Anyway, Stellantis, the parent of Jeep, Chrysler, and other brands, recently told investors that it is also working on lower-priced offerings for the United States. Those included 7 new cars under $40,000, including a couple that would cost under $30,000 in the coming years. Asian automakers such as Toyota, Nissan, and Hyundai still offer smaller, more budget-friendly cars, but they too have emphasized larger SUVs and trucks in recent years. Many automotive industry analysts were certain that the auto market would return to its 17 million a year days. However, reaching that level would require a big surge in vehicles available for less than $40,000, and that doesn't appear like it's going to happen anytime soon.
Something that always comes to mind for me is that not only are they increasing the prices, but they're adding so much extra to the car to bump up repair prices as well.
I agree.
Yep.
Like I love my lane assist and adaptive cruise control in my car, but I could completely go without all the other features.
I didn't even know half of the features in my car and what they even
Right.
did.
Both of our cars have a rear view mirror, right? But it's got a camera that
Yeah.
projects it onto the mirror.
That they could have just had a piece of glass.
Just a piece of glass, a mirror.
Yeah, I think when it comes to paying more for cars, it feels worse when you get features that you don't want. It makes you feel like you're wasting money. I think psychologically, paying $30,000 for a car that only has features that you want is better than paying $30,000 for a car with a bunch of features you didn't want.
Absolutely.
It gives the feeling that you were upsold in something you didn't want and you didn't have any control over it when you bought it.
Yep.
So this is interesting. So I just had a phone appointment with a client that has downsized their housing, and they just bought the same car that we drive, and they paid $60,000 for it. 60.
Wow.
That's 10 more than ours was even
That's right.
priced at, and we're leasing ours. So, and we've been in
But
the
the sticker
shop.
price was still the same.
It was 60.
No. It was 52, actually.
That's what I thought. And so I don't know why theirs was so much more expensive, because it's the exact same thing. And I could get rid of 80% of the automation in that car and be perfectly happy.
Heck.
Yes, I like a roll-up window, but that's about it. And a windshield wiper thing, that's about it.
Probably, or maybe, hopefully, where we're headed is that since so many things are going to be automated via AI, et cetera, anyway, it may be getting to a point where somebody can get on a website and customize a car exactly the way they want it.
Yeah.
Right. And say, okay, like Corey said, I don't need this, 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 and this, and this, but I do love this and this. And robots are going to build your car anyway.
Well, Slate has that truck.
Yes,
that
it's a $10,000 truck.
No. It's going to be closer to 20 when it hits the market in the United States, because they have to have certain safety things that cost money.
But this is the one where in other countries they're selling it for 10 because it's all stripped down, right? Isn't that the same company?
10 or 15,000 somewhere. But anyway, where I was going with this is that truck comes as bare bones. Okay, it's got power steering, but it doesn't have a radio. It has crank down windows, not electric windows. It has a flat windshield versus a curved one. There's a lot of things that you don't need that they just put on there for whatever
all those
reason.
buttons.
Yeah. But like the stereo in the car, there's no stereo, but they do give you the ports so that you can say hook your phone up and then
use that.
And then you put in a wireless speaker on the dash.
Yep.
For
and that's-
$100 from Amazon.
If that. Yeah. So
instead of $2,000 from the automaker.
there's so much that we could get rid of on that and lower some of the prices of these cars.
For sure. But if you can get on a computer and a car is just made to order, like food at a restaurant,
Yeah.
wouldn't that be great?
That would be great.
And then if you could say, hey, I just spent $27,000 on a car instead of $57 because I didn't get all this crap that I didn't want or need.
But we drove by the local auto salvage yard just down here on 247 across from the base. And Sherry said, man, look at all those great used or brand new truck beds that are sitting there.
Yeah, there's piles of them.
Piles of them. There must have been 30 or 40. Well, I learned a long time ago that auto dealers, they have a standard and they build the car to that standard, okay? Going in and deleting a bunch of stuff out of it, like taking the bed off, because they took the bed off so they could put a work bed on the back of it. But automakers will charge you more for a custom vehicle like that, even if you don't get the bed. They're still going to charge you more because they have to do extra work at the factory to make that truck come out like that. But I like your idea about starting with nothing but a rolling chassis and add the stuff you need.
Right. And robots are going to do it.
Yeah.
Right. AI is going to do it.
Right.
So it won't be any extra work for any person.
That's right.
I like it.
I like it. Anyway, the average S&P stock is up 8.6% since the index low. The 10 stocks with market caps of $1 trillion or more are up 22.9%. Wow. And the 19 stocks with market caps above $500 billion are up an average 38.2%. And 3 have doubled or more. But remember, the S&P 500 is market cap weighted, meaning the largest companies like Apple and Microsoft, Nvidia, and Google dominate the index returns. And when they surge, the index looks strong, even if most of the other stocks in the index are lagging. A handful of giants can pull the entire index upwards or downwards. And in AI news, the Federal Reserve's 2025 survey of household economics and decision-making found that 1 in 4 workers had used generative AI on the job in the prior month, and 81% of them said that it saved them time. AI users were also more likely to expect the technology to improve their career rather than worry about replacing their job. It's a help, not a threat, in their opinion.
Love that.
Yep. I think they're probably teaching that in schools starting in kindergarten. Anyways, the Idaho chip maker that doubled to $1 trillion in 48 days, a potato tycoon who couldn't type, was the first to bet big on Micron. Now the rest of the world is catching on. The Boise, Idaho-based maker of memory chips closed above $1 trillion in market value for the first time on Tuesday, a sign of how even the most basic elements of the AI build-out are getting swept up in the year-long frenzy for semiconductor stocks. Shares of Micron rose 19% on Tuesday, solidifying the country's largest homegrown chip maker as the latest flag bearer of the semiconductor rally. The stock has surged about 80% in the past month. As full disclosure, we hold this stock in our managed client accounts.
Yep. With its dizzying rise, Micron is the 12th U.S. company worth $1 trillion and the first based in Idaho, cementing the fastest run to a 13-figure valuation ever seen. The company reached the threshold only 48 days after it was first valued at $500 billion. That's according to the Dow Jones market data. Now, if you compare Micron's meteoric rise to NVIDIA, the undisputed champion of artificial intelligence chips, it took them 490 days to pass the same benchmark.
And we also own NVIDIA in the client portfolio, so this is not a recommendation, just disclosure.
Yep. The stock might have yet more room to run yet as Micron builds capacity to accommodate the biggest supply crunch in memory in the memory industry that they've seen in over 40 years. On Tuesday, UBS raised Micron's price target to $1,625 from $535, and I think yesterday it's trading at like $980, something like that. The increased price target points to expectations for longer-term undersupply of the two major types of memory: DRAM, which is dynamic random access memory, which provides storage for faster data processing in servers, PCs, and other electronics, and the NAND, which stands for not and, which provides long-term data storage, such as storing photos on a phone.
Micron has the largest market share for both memory types that Randy was just talking about of any U.S. company. Micron was founded in 1978 with startup funding from wealthy Idaho potato farmers, like Sherry was saying, like J.R. Simplot, who was facing a slumping stock and a takeover attempt in China a decade ago. That's Micron. But in recent years, it expanded its global footprint and shifted into data center HBM chips, which are designed to deliver extremely high data bandwidth with lower power consumption. These chips are what is driving the demand and the soaring profits. The company earned a nod from President Trump, who at a rally in New York said, "Boy, Micron's great." Basically, everyone's watching the company right now. U.S. semiconductor and memory stocks rallied across the board in Tuesday's trading after a brief cool-off early last week. The PHLX Semiconductor Index rose 6%.
The revival accelerated Friday when shares of Qualcomm rose more than 12% on the company's deal with global automaker Stellantis to support AI-powered vehicles. The momentum continued in Asia with South Korea's KOSPI index rallying 2.5% Tuesday to a record close, helped by the rises in chip-making champions Samsung Electronics and SK Hynix. On Tuesday, renewed enthusiasm for the chip stocks helped lift the tech-heavy NASDAQ index up 1.2% and the S&P 500 up 0.6%, reaching a record.
So my brother worked for Simplot in Caldwell, Idaho, and when I was 15, he offered me a job, and I took it. So they drove me down. My dad drove me down to Caldwell, and the entire summer of that year of being 15, I was pulling weeds 8 hours a day in their fields. And they were mostly potato and onion fields. And they would drop us off. It'd be me and 8 Mexican ladies, Hispanic ladies, I should say, but I know they're from Mexico. And we would be on our hands and knees for 8 hours a day pulling weeds, going down these lanes of these paths of these.
Look at the good memories you have.
I did. I mean, it was a life-changing experience because it was my first job where I made a lot of money. But Simplot, it just amazes me that he is that involved in this. It is a massive, awesome company.
Yep.
Did you talk about that job last week when we talked about our early jobs? I don't think you did.
I think she missed that one.
That was the Raggedy Ann outfit where
That's
I was
right. That you still own.
Yeah.
That's right. Still hanging in the closet. All right. So speaking of all this, Ford's stock is surging, and it's got nothing to do with its car business. This was a great read. Ford Motors stock price has surged to its highest level in nearly 3 years, and the reason does not have to do with cars or trucks. Over the past 2 weeks, Ford stock has risen 28% after the company announced a new energy storage subsidiary, Ford Energy. That division, which launched with a $2 billion investment, seeks to turn batteries once destined for electric vehicles into stationary energy storage systems for AI data centers, power utilities, and large industrial customers.
That's genius.
Yeah. The move puts Ford in competition with other major battery-making companies like Tesla and LG Energy Solution.
Yep, that's a great idea for Ford. And for them, most bullish investors, for Ford's most bullish investors, the division represents an opportunity to capitalize on the AI boom and the soaring energy demands in the United States. right as the auto industry slogs through an EV downturn and suddenly has far less use for batteries than it had anticipated. Ford closed Tuesday at 1532, the highest since 2023, and then it went on to go over $16.50 by the end of the week. And that's out of step with its crosstown rivals. Since the start of this year, General Motors shares have dropped about 2% after rising more than 50% in 2025. Shares of Jeep and Ram, parent Stellantis, have fallen about 28% this year. So it's not a great time for U.S. automakers.
Even since the time we wrote this up, which was only a couple of days ago, Ford stock actually approached $18. So, man, just a huge rise in a short time for them.
Good for them. In particular, investors are optimistic about Ford Energy's involvement with the Chinese battery company Giant Contemporary Amperex Technology, or CATL, the world's largest battery producer. The company's stock began to surge earlier this month after a Morgan Stanley analyst estimated Ford's energy arm could be worth $10 billion. The move to diversify into new revenue sources comes as the automotive industry navigates rough waters in 2026. New car sales are struggling, as we mentioned, as sky-high prices continue to weigh on consumers whose budgets are already stretched thin. The war in Iran sent oil prices upward, a possible strain on Detroit, which relies heavily on sales of large gas-powered trucks.
Meanwhile, Ford has dealt with unique challenges of its own. Ford must accelerate production of F-Series trucks to meet its goal of recouping lost pickup volume in 2025, which has been further complicated by rising aluminum prices. While it will take time for Ford to turn its energy arm into a revenue-generating enterprise, its first deliveries to consumers are planned for late next year. The move represents a bright spot for the industry that made a major bet on EVs but was forced to retreat amid changing regulations and waning consumer demand. The enthusiasm for the energy business is being driven in part by the automaker's battery partnership with CATL. Ford is licensing CATL's low-cost technology for factories in Michigan and Kentucky to make batteries.
And just backing up just a little bit, in case y'all didn't know, the Ford trucks are aluminum-based bodies. So that's the reason they were talking about the aluminum prices going up.
Right.
Not steel-based like other cars. All right. That's an interesting and bold move for Ford for sure. All told, Ford Energy plans to deploy at least 20 gigawatts, that's 2 with 10 zeros behind it, hours of annually of the company's battery storage systems. A 20 gigawatt output is huge. That will be enough power to provide electricity for 15 to 20 million homes, or 2.8 billion standard LED light bulbs. Ford has already has a large-scale agreement with energy company EDF, which calls for Ford Energy to supply 4 gigawatt hours annually, beginning in 2028. Ford has to quickly notch additional similarly sized deals to prove the energy business will meet the projected demand. Ford's recent stock surge is unusual for the auto industry. Only Tesla, which has more recently become focused on autonomous vehicles and robotics, has enjoyed similar rides with its stocks over the non-car ventures. Good for them.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
Up next, preparing for college education costs. Yesterday, May 29th, was 529 Day. 529 Day is a friendly reminder to families and friends that it has never been easier to help save for a child's future. By contributing to a 529 savings plan, you help prepare a child for whatever path they choose. Depending on where your child or grandchild chooses to attend college, the cost can vary. If your child chooses a private college, the average cost has climbed to $243,000 for a 4-year degree, which
Ouch.
That's insane.
Ouch.
it's really insane.
What a way to start your career.
Right.
That deep in debt.
It is little wonder that many American families are concerned about their college savings.
Either that deep in debt or that much dug into your parents' retirement.
You're right.
One of the two.
And can you still get a job?
Yeah, that's the big question. A 529 plan is a state-sponsored investment program that provides families with an easy and effective means to save for future college costs and or tuition expenses at an elementary or secondary public, private, or religious school. 529 plans can also be used for apprenticeship programs as well as qualified education loan repayments. But 529 plans also have tax, retirement, and estate planning implications. Most states have a 529 plan of some kind. Most of these programs are open to residents and non-residents of the sponsoring state, so you can shop among them for the one that best meets your objectives.
Let me jump in here. You do not have to have a financial firm set a 529 plan up for you. You can go on to the
Their website.
pathtocollege.com and do it for free. It's really easy to do it. So don't think you've got to go pay somebody to do this.
Correct. In fact, it's not even allowed in Georgia.
That's right.
We can't service them at all. So, but to your point, Randy, and I've walked several people through it over the years, the website's extremely user-friendly and very, very easy to set it up.
Unlike most other tax advantage programs, 529 plans are open to everyone, regardless of income level, and you can name anyone as a beneficiary regardless of their age. You can establish account for children, grandchildren, niece, nephew, or with some plans yourself. Many 529 plans, depending on the state, will allow you to make contributions up to an account value of $400,000 or more with no time limit on its use. Georgia's cap is $235,000. 529 plans provide several benefits, including tax-deferred earnings, withdrawals that are free from federal tax if used for qualified educational expenses, high contribution limits, and other education savings programs, or higher limits than other education savings programs. 529 plans allow you to roll over money from one state's 529 plan to another's. You may also do any of the following: change beneficiaries as long as the new beneficiary is in the same immediate family, fund the education of a child, grandchild, niece, nephew, family, friend, or even yourself, and control account withdrawals even after the beneficiary reaches legal age.
Yep. Jonathan, you got anything to add to the 529?
Yeah. I mean, I don't think anything is in here about it, but now, I mean, when we've talked about this, the fact that if it's not used for college or passed to an immediate family member, it can be converted to a Roth in the beneficiary's name is a huge deal.
It is.
It's a huge deal, and it really should incentivize people to do 529s more, because if they know that it's not going to be just wasted dollars or penalized dollars,
Right.
then they can move it into a retirement account tax-free for that beneficiary.
That's right.
So I don't think this article talks about that at all, but it is worth mentioning.
Yes.
That's a great
big
point.
time.
All right. Well, graduation season is a milestone worth celebrating. But once the cap and gowns are thrown and the family photos are taken, there is a financial inflection point that most families never talk about. And that is what happens to all the money that you've been spending on your child's education. For families paying college costs, the end of tuition can free up between $27,000 and $60,000 per year, depending on the school. That's a significant shift in the cash flow in your household. But here's what the data tells us about what actually happens next. For many families, that money doesn't get redirected towards new financial goals, including parents' retirements. Instead, it quietly flows into the continued support for the adult children.
Yeah, and we've talked about this a lot too, especially in recent months, but the numbers are actually pretty striking. According to a 2025 Savings.com survey, half of all parents with adult children now provide regular financial assistance, spending an average of $1,474 a month. Working parents who support adult children contribute more than twice as much to their own grown kids each month as they do to their retirement accounts. AARP found that 75% of parents aged 45 and older are financially supporting at least one adult child, even though more than half of those children are capable of meeting their own basic needs. 42% of supporting parents report financial stress as a result. None of this comes from lack of love, it comes from a lack of structure. Without a clear direction for when and how support will taper, the transition from helping with college to indefinitely subsidizing an adult happens gradually and invisibly even.
I'm seeing it with my clients. Okay, so let's discuss why graduation is the right moment to reset. Graduation creates a natural opening for conversations that might otherwise feel uncomfortable. Both generations expect things to change, which makes it the ideal time to clarify a few things. You should discuss what expenses will shift to the graduate and on what timeline, what the graduate needs to know about enrolling in employer benefits like health insurance and retirement plans, and what the parents can realistically continue to provide without compromising their own financial position.
So where should the recovered cash flow go? For parents in their 50s and early 60s, the end of tuition creates a rare opportunity to accelerate retirement savings during the years when it matters most. The 2026 Employee Retirement Plan contribution limit is $24,500, with catch-up contributions of $8,000 for those aged 50 and older, and a new super catch-up of $11,250 for those aged 60 to 63 under the Secure 2.0 Act. If both spouses are working and contributing, the combined annual opportunity can be considerable. It's also a good time to evaluate whether Roth conversions make sense before Social Security and required minimum distributions begin. Having a strategy in place is key if you're considering this opportunity.
So here's the real question. The decision to support an adult child is deeply personal, and there is no single right answer. But the question worth asking is whether that support is happening intentionally as part of a broader approach, or whether it's happening by default because no one has had the conversation. If your family is approaching a graduation milestone, or if you're already supporting adult children and wondering how it fits into your broader financial picture, sometimes having an impartial listener/financial advisor can help you make sense out of complicated issues like this. So please call and make an appointment with one of our advisors. We'd welcome the conversation. And I will tell you that I have a lot of clients who have stories of supporting children and grandchildren, and most of them can afford to do it. Some of them cannot afford to do it. And I have one that I just had a phone appointment with a couple weeks ago, and she is supporting a child because the child is disabled, and nobody else, the person who had the child, is not capable of supporting her. And she can barely make ends meet. Yeah. Barely.
You know, last night we went out with a friend just to enjoy the beautiful Macon air last night. It was great. And he was talking about, he just celebrated or watched both of his daughters graduate. And one of them came back to him and said, "Hey, I'm thinking about going on for my master's. It's going to be another 2 years." And he goes, "I think that's just a great idea as long as you can afford it." You know, and I mean, he set the expectation.
Probably not what she
I'll
expected.
Get you your bachelor's, anything beyond that, and then she came back to the well, and it was dry. So,
yeah.
Anyway,
You think she'll still pursue it?
I do. Yeah,
And she's extremely smart.
yeah,
Very driven, obviously.
She is. So, all right. Goldman, meaning Goldman Sachs, has misgivings about the stock market, but it just raised its S&P 500 target anyway. Goldman Sachs boosted its year-end price target for the S&P 500 on Wednesday, citing solid earnings tied to artificial intelligence investments, the wave that is likely to power the benchmark higher over the summer months and beyond. The AI investment theme, in fact, is likely to power nearly half of all S&P 500 earnings growth over the next 2 years and offset the headwinds tied to softening consumer spending and rising inflation pressures.
Yep. Goldman sees the S&P 500 rising to 8,000 by the end of the year, which is about a 6% advance from the current levels, which would peg its 2026 gain at around 16.6%. Randy, I remember not too long ago a few months ago when we were in here talking about the S&P 500 approaching 7,000.
That's right.
And now here we have projections for 8,000. A very strong first quarter earnings season where data suggests an overall gain of around 29% for the S&P 500 profits was powered in large part by the AI investment boom, remains key to Goldman's updated price target. Those gains, however, have come amid a decline in the overall price-to-earnings multiple for the benchmark, which is down 4% since the start of the year.
AI-related stocks have powered the bulk of the S&P 500's overall gains since the start of the U.S. war with Iran in late February, rising by more than a third compared to the meager 1% advance of the equal-weighted benchmark. Earnings forecasts on the AI side, however, have increased by nearly a third as well. Fundamentally, earnings strength has been the key differentiator between the recent market run and similar narrow rallies in the past. Within equity portfolios, the stocks with the strongest earnings revisions have generally outperformed year to date, and we expect this to continue to be the pattern going forward. The hyperscalers and stocks tied to investment in power infrastructure stand out as attractive opportunities.
Beyond tech, however, earnings growth is still impressive, with the median S&P 500 company seeing 14% year-over-year boost in their bottom line, the strongest gains in a decade outside of the tax cut years of 2018 and the post-COVID opening rebound of 2021. Goldman sees overall earnings growth of 24% this year, taking the overall bottom line for the S&P 500 to $340 a share, topping the current forecast of $337 with a 2027 outlook of $385 a share.
Analysts note some levels of concerns to the AI concentration driving the bulk of market gains, even if it's been powered by the staggering earnings strength of the sector itself. And he sees two key concerns slowly developing. The first is an excess of speculative risk-taking that skews the distribution of market outcomes to the downside. The second is a deteriorating fundamental backdrop that has historically included a tightening Federal Reserve and a weakening outlook for some earnings growth. The CME Group's FedWatch tool is now pricing the modest chance of a Fed rate hike between now and the end of the year, and doesn't indicate any prospect of easing until the summer of 2027.
Yeah, that, as well as a surge in global oil prices tied to the war with Iran and the uptick in inflation pressures, has lifted the Treasury bond yields to multi-year highs, with longer-dated 30-year bonds hitting the highest level since 2007 as recently as last week. Beyond the macro concerns lies the central test to continue growth and Wall Street's current market optimism, and that is, what will the impact of AI be on the long-term earnings growth?
But Goldman doesn't see that being answered anytime soon, with the uncertainty surrounding which companies will experience long-term earnings uplifts from AI helps explain the practical focus of most investors on the near-term earnings impact from AI. But that focus can create the risk that investors overvalue the long-term benefits. Beyond the next several quarters, the sustainability of current earnings momentum will depend on the ability of corporate America to translate current AI investments into recurring profits.
All right, let's shift gears here. You hear a lot of talk about bubbles, so let's talk about why it's so hard to spot a market bubble. If the stock market bubble, if the stock market's a bubble, that's dangerous. If you're positive it is or it isn't a bubble, that could even be more dangerous. In April, the semiconductor stock rose more than 38%, their highest monthly return since February of 2000. Google's parent Alphabet gained 10% on April 30th, adding more than $241 billion in market value in a single day, the second largest one-day gain in the stock market history. A recent newsletter asked the question, are we in a bubble? Readers from across the United States and around the world weighed in.
Yep, and their answers ranged anywhere from, in short, yes, to we are definitely in a bubble, to no, it's not a classic bubble. One reader said, while the increase in prices is extraordinary, prices continue to rise because earnings continue to rise. Earnings are the mother's milk of the market. That was according to that reader. The bottom line is that bubble spotting is a lot harder than it seems. If identifying a bubble was easy, then we would all do it, and we could all do it. And if we could all do it, then a bubble wouldn't form in the first place.
That is true, and investors would see it starting to swell. Then they would promptly sidestep or bet against it, deflating the bubble before it could expand anywhere near the bursting point. What's more, it's easy to misinterpret overpricing for part of the market as an indication that everything is a bubble. Much of the time, at least some companies or industries will be going up fast enough and high enough to seem like a bubble. Even when stocks look expensive, as they already did several years ago, it's hard to be certain they're doomed to collapse. After all, few people back then correctly anticipated how giddy investors would later get over artificial intelligence.
And after AI, some other transformative technology could emerge, just as AI has supplanted the enthusiasm over cloud computing, fracking, the internet, and earlier breakthroughs that lifted the market. A few variables can take some of the guesswork out of trying to identify a bubble. Owen Lamont, a portfolio manager at a firm in Boston, has written extensively about market extremes. One definition of a bubble, he jokes, is when I think the stock market is overpriced and then it doubles, as in 1999, that year the NASDAQ 100 index gained 102% after returning 85% in 1998.
Yep. And more seriously, Lamont looks back at history and identifies several indispensable ingredients for a market bubble, not just high stock prices, but also high volatility and trading volume. as well as the spread of what he calls the bubble beliefs. You know, if you're at the gym and or getting a haircut and everyone's talking about, are we in a bubble? Lamont says that's pretty much a good clue that we might be in a bubble. And another necessary bubble ingredient is defensiveness. When the fans of an overpriced asset go from touting its benefits to attacking its critics, you can be fairly sure it's becoming a bubble. That's what happened in the late 1999 and the early 2000s with the internet stocks and the 2021 with Bitcoin, when proponents lash out at skeptics right before the prices collapsed.
Yep, that tone is not dominant today, suggesting that we're still not in the red zone. The last of what Lamont calls the four horsemen of a bubble is a tidal wave of stock issuance. Think back to 2021 when hundreds of special purpose acquisition companies, the black boxes called SPACs, S-P-A-C, issued a new stock. When that bubble burst, outside investors lost at least $100 billion. Or consider the dot-com mania of the late 90s, when eToys, Pets.com, and hordes of other flash-in-the-pan internet companies drenched the market with initial public offerings of their stock. But this time it's different. Bubbles usually start with legitimate economic innovation like...
I think it's real,
legitimate economic innovation like AI. Inventions like the internet or AI create believable stories about infinite growth. And then you start to see metrics that investors create to justify the flawed evaluations and justify the extreme prices.
So far, at least, new stock offerings haven't been flooding the market. That looks likely to change, though, if SpaceX, Anthropic, OpenAI, and other giants go public later this year as widely expected. Issuance is the thing Lamont is keeping his eye on. The ultimate sign of a bubble is performance-chasing behavior. An asset goes up in price because people are buying it, so more people buy more of it, making the price go up even more. In recent months, though, what we've seen is the opposite. Individual investors have been buying stocks on bad news about tariffs or war or inflation. This is contrarian, not performance-chasing behavior. Classic bubbles are buy the rip, not the dip. That is classic FOMO mentality. You watch your peers make fast profits and rush in blindly. That is classic human psychology and herd behavior, which I lived on a farm and I've seen the herd.
But that isn't the only hazard. After all, if you're positive you can identify a bubble, why wouldn't you believe you can predict when it'll burst? In that case, why not buy the riskiest stocks that will boom the most? The real danger of bubble spotting is believing you can do it. Many investors have amped up their exposure until they're all in, while others said that they've bailed on stocks in response to the market's rise. But stocks aren't a toggle switch that you can flip on or off. Few investors should have either all or none of their money in stocks. The future is rarely certain enough for that.
Yep. Now is a good time to make sure you are diversified, holding not just the S&P 500, but smaller stocks and international stocks as well. You should also check whether you can rebalance and trim some of your winning assets, such as large U.S. stocks, and add some recent laggards like bonds. Remember a few points. Markets can stay irrational far longer than short sellers can stay solvent. The next one is often when there is a massive amount of cheap money being thrown around, this can hide the underlying structural risk. And the next one is there are no peak indicators. No technical indicator can predict the exact day that the crowd is going to turn. And lastly, be careful of where you get your information. The media loop is insufferable. Financial news amplifies excitement to maximize viewer clicks, and they won't care if you make money or if you lose money as long as they can monetize the clicks on their site. All right.
And a side note, we have trailing stops in our portfolios that you use.
Yes.
And that's extremely helpful.
All right. Shifting gears. A new powerful cholesterol-lowering drug is on the horizon. I'm glad to hear that personally. A new class of drugs is poised to take an insidious cause of heart attacks and strokes that has eluded treatment for decades. Researchers could know as soon as this summer whether the most advanced experimental drug from Novartis and its partner Ionis Pharmaceuticals cut heart attacks, strokes, and death in a study that could be used to get their drugs approved by next year.
Amgen and Eli Lilly are also developing medicines that lower the level of lipoprotein, a fatty particle in the blood that is known as LP. It can cause plaque to build up in blood vessels and is linked to heart disease. Tens of millions of people in the U.S. have elevated LP, and there's an A after it anyways, an inherited and largely hidden driver of heart disease. If LPA drugs work, companies could be on the verge of the next big heart drug market. City analysts estimate it could be valued as much as $25 billion a year worldwide.
This isn't a sure bet, though. Effective LPA drugs have proven difficult to develop. In the past, scientists found drugs that lowered levels of the particle a moderate amount, but failed to reduce heart attacks and strokes in research studies, leaving patients with no approved treatment. LPA is an especially treacherous cause of heart disease. The particle is a variant of LDL, the so-called bad cholesterol. Like its cousin, high levels of buildup in arteries threaten heart attacks and strokes. But the problem is, 6 decades of research has so far failed to prove that lowering a person's LPA will actually reduce their risk of heart attacks and strokes. For LPA drugs to work, scientists say they must significantly lower overall levels of the particle in the body.
Yep. Diet and exercise won't lower LP. About 90% of a person's level is fixed at birth. Doctors usually prescribe other cholesterol treatments such as statins to manage the overall cardiovascular risk. Yet, statins can raise LP levels. That's terrible. Roughly 1 in 5 people globally have dangerous high levels of LP, according to Dr. Neeson at the Cleveland Clinic, who is involved in trials to test several of the drug's developments.
Neeson says that LPA hardens arteries and promotes clotting, which is why it is so noxious in terms of increasing adverse cardiovascular events. Drug makers are using new technologies to attack LPA now. Both Amgen's experimental LPA drugs and Lilly's most advanced treatment deploy a gene-based technology that aims to silence the gene that produces LPA. Amgen's late-stage trial is expected to have results in the next year or two, while Lilly's late-stage trials results aren't expected until 2029.
The therapy from Novartis and Ionis uses a different gene-based technology that blocks the signal telling the liver to produce LPA. Bill Haim, who is participating in the Novartis trial, didn't find out that he had high levels of the particle until he suffered a particularly bad heart attack. When Helm woke up 3 days later, his doctor delivered the news. His LPA level was more than triple the threshold of which American Heart Association says it starts raising heart risk.
Most people have never had their LPA level tested, according to Neeson, the Cleveland Clinic cardiologist. Doctors have been hesitant to order the test for patients because there aren't currently any approved drugs to directly lower the particle. Medical bodies updated guidelines earlier this year to recommend LPA testing. If the drugs work, the question will be who exactly should get them. The drugs might prove clearly effective only for people with extremely high levels of LPA. If the benefit for patients with lower levels is murky, the drugs could end up being covered by insurers only for those at very high risk.
Yep. And then there's the question of the cost. A decade ago, health plans balked at paying for powerful new cholesterol-lowering drugs called PCSK9 inhibitors because of pricing. Drug makers essentially slashed the prices to about $200 a month from roughly $1,000 a month before issuers would cover them broadly. Analysts have estimated that the annual price for LPA drugs could be similar to the ones approved for the PCSK9 drug, but a lot depends on the coming study results. Amgen argues that the near total elimination of particle is what will be meaningful to reduce the heart attacks and death. This could prove to be important, especially in patients who benefit from decades of improving other risk factors management. So
I have a quick cholesterol story.
Okay.
So I went to the doctor about 10 years ago for my annual physical, and he's looking at my blood work, and I'm sitting there, and he said, I'm putting you on a statin. And I said, wait a minute. I said, I don't want to take a statin. I refuse. I said, I have clients, and they tell me the symptoms they have after taking it. I'm not interested in taking it. And he sits me down at a table and takes a pen and paper, and he draws an artery with all these clogs in it. And he said, here's what you're going to look like if you don't go on one. And I said, you can go and prescribe it. I refuse to take it. I will not take it. My family has genetically high cholesterol. So he got really upset with me, went on with my blood work, and I left. Well, the next year, I'm sitting there, and he's going through my blood work, and I'm sitting in the chair watching him scroll through it on his iPad. And I said, so how does my cholesterol look? And he goes, oh, you're perfect. I said, really, I'm perfect? And he goes, yeah, both your levels are high. So you're a 2. You're a 2 out of, if you're between a 1 and a 5, you're perfect.
They changed the metrics.
They changed the metrics in the system, and all of a sudden I was perfect, or I would have been taking a drug I didn't need.
That's right.
Question everything.
Yep.
I tell you, look at your own blood work. Understand how this stuff works. Read up on it. And don't just assume that everything that they tell you you're going to take is right, or that it won't combine toxically with other drugs that you're already on from some
Absolutely.
other doctor. And I'm seeing a lot of that with my clients. I've had clients with a whole page of medications they're taking, and they have no idea why they're even taking them.
And as a veteran, I went down to the VA in Dublin, and there was a person down there. I can't remember what their title was, but they took a look at my prescriptions and they go, "Okay, you don't need to be on this because it's also in this." And
There were like 4 things that were
Yeah,
wrong that you
that's
shouldn't
right.
have been taking that
Yeah.
other people prescribe because they don't look at what you're taking.
That's right.
So be careful, please.
Look, everybody, thank you for being with us this wonderful Saturday morning, and I hope that you'll come back and visit with us next week. And so, with that, we will talk to you next week.
Have a great weekend.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.